recorded. So if you want to see a copy of the basics of stochastics, you can use the link you used to come to tonight's class, or in about next week sometime, you should be able to locate it by going to investing.com and looking under the education tab and looking for webinars on demand. So let's get started with the basics of stochastics. Now, I've put together a handout for you that you can see right there on your screen. You can download, and it's a general guideline on understanding stochastics and using stochastics. It should help you along the way. Now, if you're listening to a recorded version of this class, you will not have access to the downloadable guide, and is only available to people in the live class tonight. Now, stochastics falls into a group of what's known as technical indicators, and then a category known as oscillators. Okay. One of the most regularly followed trend indicators is stochastics. It measures the distance between an opening price and a closing price and the range of high and lows over a specific period. Now, it was originally developed by Gerald Appel by George Lane for the stock markets, because when it was developed, that was about everything that was available in the marketplace, and there was no such thing as online trading. With time and a change in the markets, so has stochastics been revolutionized and works great with all financial markets and all online trading. So proponents tend to like the stochastics oscillator because it's easy to remember defined ranges. Now, when we talk about technical analysis, there are different parts of technical analysis, because technical analysis is everything that's done on a chart. So you have chart patterns, you have trend lines, you have support and resistance lines, and then you have a group of things called indicators. Indicators are usually mathematical calculations that are dropped either over top of price action or, in most cases, underneath on the charts and have their own little lines on a chart. Now, in this group of oscillators is a group or a subgroup or a sector called bounded oscillators or bounded indicators, and that means they are bounded between two numbers. In most cases, they're between 0 and 100. So whenever you calculate stochastics, it will always fall in this range of 0 to 100. And then in that range has another sub-range, which could be in some cases 70 to 30 or 20 to 80, depending on which bounded indicators. That really doesn't tell you much. You're looking for indications when the value of that oscillator goes above a specific level. In the case of stochastics, it gives us overbought and oversold areas, which are above the number 80 and below the number 20 when they're calculated. So Dr. George Lane developed the stochastics oscillator in the 1950s. Dr. Lane was quoted as saying, if you visualize a rocket going up in the air, before it can turn down, it must slow down. And that's basically what stochastics does. It shows you when an asset that has been moving up or down is losing its momentum. It hasn't reversed yet, but it's like that rocket going up in the air. At some given point, that momentum is going to start to reduce, even though the rocket's going to continue going up, but we can then predict when it's going to fall over and turn back down to earth. And this is what stochastics does for us. And this is what is considered overbought and oversold. Because an overbought market can remain overbought for a period of time. An oversold market can stay oversold for a period of time. It's when that trend is losing its feet. So there are the steps to add stochastics to your view. So let's go over and look at how you would add stochastics onto your chart. And then we'll talk about where they come from. So let me pop up a chart on your screen. Okay, so we're looking at just my gold working chart that I use for class all the time. And I've already dropped the stochastics down below. But all you have to do is locate the indicators on whatever charting service you're using and scroll down to stochastics. That's it. Almost every charting service, in fact, I don't know of any that doesn't offer stochastics. And you click on it, and it's going to drop the stochastics oscillator on the bottom of your chart. Most of them will give you the 80 to 20 zone. So as you can see over here, there is the here's the boundaries, the 100 and 0, and then here's the 20 to 80 range, which I have background in the purple, is, I call it dead man zone because there's no action actually happening there. We're only concerned with when it's over the 80 level and below the 20 level. And stochastics are made up of two lines. One's called the %K and one's called the %D. And we're going to talk about where these come from in a minute and what the calculations are, because you have to understand where they're calculated from and how they're calculated so that you understand how this indicator is put together. And then you can then also helps you understand when it's giving you false or bad signals. But as you can see, I'm going to click up here on my indicator, and you see we have the %K, the %D, and I just put those in the red and the blue. So we have %K in the blue and %D in the red. And the inputs are %D is based on a 14-day moving average, %K is based on a 3, and is smoothed out over a 3 period. Okay, and I'm going to show you what all that means in a second. So let's go back to my PowerPoint. Let's talk about what all this means or how it all gets on the chart. And then we'll talk about how to interpret it. So you'll notice, okay, the fast moving line is shown is the %K. Here it's in black and mine is in blue, and the %D is in red. A slow stochastics moves the %K line using a default 3-period simple moving average. The %D then reflects a moving average of the %K. The %K crossed over the D line, giving an indication of support. Okay. Now, all that sounds like a bunch of nonsense. And we're going to look at these formulas so we can bypass the words. But a stochastic oscillator is a momentum indicator comparing the closing price of a security to the range of its prices over a certain period of time. So what we're doing is we're taking a 14-period time. If you're looking at a 15-minute chart, it's 15 minutes. If you're looking at a one-day chart, it's 50 minutes. We're taking the closing price of that security. Okay. So when we get these numbers and we've added together and divided and come up with the %D and the %K, we can then place these on our charts. So as you can see here, you'll notice we have two lines. And what we're looking for is the crossovers between the two lines and the height in where they are when they cross. So we're looking for the two lines to cross above the 80 period or below the 70 period. So the general theory serving as the foundation for the indicator is that a market trending upwards, prices will close near the high. And in markets trending downwards, prices will close near the low. Okay, that's all that the basics of this is. Okay, transaction signals are created when the percent K crosses through the 3-period moving average, which is called the percent D. So we start out with the 14-period K, which is 14 closing prices, smoothed out. Then we have that average with a moving average, a 3-period moving average, which gives us the percent D. Similarly, when you look at MACD, we're doing the same thing. We call it there a MACD line and a trigger line. Here we have the percent K and the percent D. So Lane also expressed the important role that the stochastic indicator can play in identifying overbought and oversold levels because it is range bound. This range from 0 to 100 will remain constant, no matter how quickly or slowly a security advances or declines. Now, I know a lot of this is a little bit confusing, and I'm sorry for that, but that's why I gave you the handout, because in the handout, it follows along step by step, and you can look at the examples and see what we're talking about. But basically, you're having a moving average, you're having a smoothing, a look back period, where we're looking back so many days of an asset or so many periods of an asset, plus the current closing price. And then we're having a crossover line, which is like a moving average crossover, which is the percent D, which is simply a 3-period smoothing of that original calculation. When these are put on a chart, the number with the percent K, the percent D is, the percent K is put on a chart with a dot, and those dots are connected in a line, and the percent K, and the percent D is put on a plot, on a chart plotted, and it gives us 2 lines. So I'll try to break it down a little bit for you. The stochastics oscillator is calculated using the following formula. Percent K is equal to 100 times the close minus L14. L14 is the low of the last 14 trading sessions. That is divided by the high of the last 14 sessions minus the low of the last 14 sessions. So it's not a complicated mathematical calculation. Okay, and on your handout, I gave you very precise examples where we've actually used numbers, but you're simply taking 100, just to give it a whole number, you're multiplying that times the most recent closing price for the last candle, minus the look back period, which is 14 periods of previous trading sessions, and you're looking at the lowest price, it was at those 14, there's 1 hour candles of 14 1 hours. You're then dividing that by the high, that's the highest price that asset reached, which is the top wick of the candle for the last 14, minus the lowest price for the last 14. And you're just doing that calculation period. And that gives you the percent K. Then you take the percent K and you just take 3 periods of the percent K and add them together and divide them to come up with the moving average to give you the percent. If you understand math, it's not complicated. If you just understand arithmetic, it's not complicated. It's just going back. So the general theory serving the foundation of this indicator is that if the market is trending upward, prices will close near the high. And if a market is trending downward, prices close near the low. So in other words, if you see an asset moving in an uptrend, most likely, statistically, it will close near its low, near its high. As I just got a sound check. Okay, hopefully the sound is still working. Something popped up on my screen telling me there's a problem with the sound, but we'll keep on going. So the premise for stochastics holds that a stock's or an asset's closing price tends to trade at the high end of the day's price action. Okay. Price action is the price at which the asset traded throughout the daily session. The stock may have opened at $10, traded as low as $9.75, and as high as $10.75 and closed at $10.50 for the day. The price action for that example is between $9.75 and $10.75. If the issue, however, is currently in a downtrend cycle, the closing prices will tend to close near or at the low, or if it's in an uptrending cycle, will tend to close near or at the high. Now, there's no guarantee of this. There's no reasoning for this, but statistically, we're using probabilities, this is what's likely to happen. So the percent K line is the fastest, and the percent D line is the slower of the two lines. In other words, the percent K line reacts faster. The percent D will react a little bit slower because it's just an average of the previous. So the investor needs to consider selling the stock when the indicator moves above the 80 level. Conversely, the investor needs to consider buying an issue that is below the 20 line and starting to move up with increased volume. So volume is a key that you should always be looking at when you're looking at considering trading and looking for some determination of how price is moving. If you see volume moving up with the indicator, and when you get a crossover telling you that you should be buying or selling, you should see an increase in volume because the other traders are moving in that direction. But as you can see on this chart here, we not only want it above the 80 level or below the 20, we want to cross over to at least have crossed over very close to those levels. Now, those levels are guidelines. They're not hard, fast, can't break rules. In other words, different assets may tend, or different markets may tend to, you might see that, maybe the euro US dollar hypothetically really gets overbought when it's at 76, not 80. And we also want to look for them to be over that level, cross over, and then move back into that level. So there's a lot of interpretations you might want to use. So when your stochastics is a high value, it means that the price closed near the top of the range over a certain time period. So this is the same chart that you have in the handout over there. So here the graphic shows the low was at $60, the high was at 80. So your range was $40. The price closed almost at the very top near 95. Stochastics showed 88%, which means the security only closed 12% from its absolute top. Now, conversely, a low stochastics value indicates that the momentum to the downside is strong. In the graphic, we can see that price only closed $5 above the low of the range at $50. So the main difference between the fast and slow stochastics is summed up in sensitivity. The fast stochastics is more sensitive than the slow stochastics to change. There are three actual versions of stochastics. The fast stochastics oscillator was based on George Lane's original percent K and percent D. Remember I told you it was originally developed for the stock market and then moved a little bit forward with online trading and Forex and CFD trading. Now, the percent K in the faster version that appears rather choppy, the percent D in this 3 period of the K. In fact, Lane used the percent D to generate buy and sell signals based on bullish and bearish divergence. Lane asserts that a percent D divergence is the only signal that would cause you to buy or sell. Because %D is the fast oscillator, fast stochastic oscillator is used for signals, and the slow stochastic oscillator was introduced to reflect this emphasis. The slow stochastic oscillator smooths the %K by the 3-day SMA, which is exactly what the %D is of the fast stochastics. As a bound oscillator, the stochastics oscillator makes it very easy to identify overbought and oversold levels. The oscillators range from 0 to 100. No matter how fast the security advances or declines, the stochastics oscillator will always fluctuate within this range. Traditional settings use the 80 as an overbought threshold and a 20 as an oversold. These levels can be adjusted to suit analytical needs and security characteristics. Remember, I mentioned to you hypothetically about the euro-US dollar. Readings above 80 for a 20-day stochastic oscillator would indicate that the underlying security was trading near the top of its 20-day range. Readings below 20 occur when a security is trading at the low end of its range. It's important to note that overbought readings are not necessarily bearish. Securities can become overbought and remain overbought during a strong uptrend. Overbought means there's too many buyers and the price has been pushed up too high remember the rocket example? It's losing its momentum, but we're not sure when it's going to turn over. And an overbought market can remain overbought and still continue upward for a period of time. Same thing with oversold levels. Closing levels consistently near the bottom of a range indicate sustained selling pressure. It is therefore important to identify the bigger trend and trade in the direction of the trend. Look for occasional oversold readings in an uptrend and ignore frequent overbought readings. Similarly, look for occasional overbought readings in a strong downtrend and ignore oversold readings. So you can see here on this Yahoo chart that we have our 80 and our 20. And notice every time the asset broke below the 20 level in a downtrend, it was telling us that downtrend is coming to an end. Okay, and the market is oversold, and the market finally pushed down and reversed and came upward. And each one of these works extremely well with the end of each trending market. So, I mean, I keep harping on it, but moves above 80 warn of overbought conditions that could foreshadow a decline. Notice how the oscillator can move above 80 and remain above 80. Similarly, the oscillator moved below 20 and sometimes remain below 20. The indicator is both overbought and strong when above 80. A subsequent move below 80 is needed to signal some sort of reversal or failure at resistance. So in other words, what we're looking for is it to push above the 80 and the signal for the reversal will come when it breaks below that 80. Conversely, the oscillator is both oversold and weak when it's below 20. Because some people will tell you, just whenever you see it over 80, it's overbought. So either exit the market or enter in a sell position. There's more to it than that. Okay, and don't let yourself get locked into these exact numbers. Okay. You want to see how it's trading above or below 80 when they crossed over and what historically a price has done. Now we also get divergent. Divergence forms when a new high or low is in place and is not confirmed by the oscillator. A bullish divergence forms when the price records a lower low, but the oscillator forms a higher low. This shows less downside momentum that could foreshadow a bullish reversal. Once the divergence takes hold, charters should look for a confirmation to signal the actual reversal. Now, 50 is also an important level to watch. The stochastics oscillator moves between 0 and 100, which makes 50 the center line. Think of it as the 50-yard line in a soccer or football game. The offense has a higher chance of scoring when it crosses the 50-yard line. The defense has an edge as long as it prevents the offense from crossing the 40-yard line. So think of that 50-yard line as telling you which team has gained the strength at the moment. A stochastics oscillator cross above 50 signal that the prices are trading in the upper half of their high-low range for the given look-back period. This suggests that the cup is half full. Conversely, a cross below 50 means prices are trading in the bottom half of the given look-back period, and this suggests the cup is half empty. So here we can see we have price making lower lows while the actual indicator is making higher lows. So it's moving in the opposite direction, and it also broke above 50 while the price was in a downtrend. So remember, early signals are not always clean and simple. Signal line crosses move below 80 and move above 20 are frequent and prone to whipsaw. Even after this asset here broke support and the stock oscillator moved below 50 and the stock bounced below 57, the oscillator bounced back above 50 before the stock continued to shape lower. George Lane identified another form of divergence to predict tops or bottoms. A bull setup is basically the inverse of a bullish divergence. The underlying security forms a lower high, but the stochastics oscillator forms a higher high. Even though the stock could not exceed its prior high, the higher high in the stochastics oscillator shows strength to the upside momentum, and the next decline is expected. So let's go over and look at some live charts for a second here and see if we can see some divergence. Okay, here we're looking at stochastics, and let me just highlight something for you here. So here we have our 100 and our 0 range. Here we have our 80-20, and we see that stochastics has pushed all the way up to 95.9513. It's all the way to the very top of its range. Look what's happened with price. As stochastics was moving over that 80, it continued to be bullish momentum, but it was losing its momentum. And here you can see that rocket turning back to earth and falling straight back down. Okay. It also worked extremely well with its first level resistance level. Okay. And it bounced off of that. We also have a 50% Fibonacci retracement. It bounced off. So we have it bounced above, it was above the 50%, and it bounced off the 100% of the Fibonacci level. Okay. And it overlapped a resistance level. So we have 3 major decision making, and we could have entered that asset in a short position at this point. Here's a perfect example of divergence. This is a chart for today for Ethereum versus Bitcoin. And we can see that the overall movement is making higher lows while the stochastics indicator is making lower lows. So the indicator is diverging from the price. So this is giving us actually at this point a bullish setup telling us that this little downtrend is about to end and the price should move in an upward fashion. Here we go again. I just want to get some of these markings off of here. Okay, here we go. We're looking at Bitcoin dollar today. We see price moving down steadily in a downtrend. But as it's moving in a downtrend, we have bullish divergence. Price recovered and started moving up, and this is where we're predicting price to go. And we can see how it diverged, but look at this, how the stochastics broke above the 80, stayed above the 80, and we also got a crossover at this level as the asset moved up. But as we had the downtrend developing here, we had the beautiful divergence here, which was forewarning us that this was going to happen. So here we have three beautiful elements of stochastics used in different formats and with different assets, all supporting what should have been an easy trading decision or an easy warning. Now, it's very important that, as with any other trading concept or tools, you should not use stochastics indicator by itself. To receive meaningful signals and improve your quality of your trades, you can combine stochastics indicators with those three tools we talked about. You just saw it before, Fibonacci levels. You saw volume. You also saw us use it with support and resistance. But moving averages can also help greatly. Moving averages can be a great addition here, as they can act to filter out your signals. Always trade in the direction of your moving average as long as price is above the moving average. You can also look for price formations. Price formations like triangles, wedges, rectangles, head and shoulders. When price breaks such a formation with an accelerated stochastics, it can potentially signal a successful breakout. Also, trend lines, especially stochastics divergence or stochastics reversals, can be traded nicely with trend lines. As I showed you before on the chart, we had the beautiful downtrend line. See the purple downtrend line here? With the divergence, so we had a perfect example right here. Everything comes into play, but here we're using also our support levels, but we need to be using, and we're using moving averages. So we haven't had a crossover, but we're looking for price in a downtrend to stay above the moving average. So price broke above the moving average right here. So that gave us a combination of entry signals, but the moving averages, we're using too broad of a period of moving averages here for Bitcoin. So we should have brought this back down to maybe a 30 and a 60 day, or a let's put Woody's mine was a 10 and a 20 crossover. So we'll now put those, let me make them a little bit easier for you to see. Okay, so now we can see price staying right above, because for cryptocurrencies, they're moving very, very fast. So you have to use very short-term moving averages. So I just dropped on a 10 and a 20. We can see it price underneath the price when it's breaking out. We can see a crossover right here, giving you a buy signal, as well as the indicator giving you a buy signal, and price breaking the trend line. So again, we've combined these with several different indicators, but these examples are also on the handout that I gave you. So you might not need the stochastics indicator when you are able to read the momentum of your charts by looking at the candles, but if the stochastics is a tool of your choice, it certainly does not hurt to have it on your charts. More importantly, this class is meant to make you realize how little you might know about the tool you are using for your trading. Additionally, there's a lot of wrong knowledge being shared among traders, and even widely used tools such as stochastics indicators are often misinterpreted by the majority of traders. Do not blindly believe what other people tell you. Do your own research and build your own strategy and your own knowledge base. Traders will often cite when a stock makes a higher high, but the stochastics does not exceed its previous swing high, that the trend is in jeopardy. This can be furthest from the truth. The slow stochastics indicator ranges from 0 to 100. Okay. Use the indicator. Traders will often exit long trades when the slow stochastics crosses above 80, or will buy when the slow stochastics crosses below 20. The problem is that this trading methodology is that if a stock is above 80, it should not be looked upon as an overbought, but rather as a trending strongly. So there's many strategies you can apply to trading stochastics, but identify stochastics with smooth slopes. Still not a believer? Let's review a few charts. You can see on all the charts how it works continuously and regularly. But there's lots of ways to include stochastics into your trading. But you have to decide how it works, how you're going to apply it, and what you want to do with it. Because trading is not that simple. Now, I don't want to leave you with the impression you can simply buy or sell stock or an asset when it is hitting a trend line and going above 20 or 80. Trading is not that simple. You can, however, utilize the slow stochastics to validate the health of a trend line relative to previous peaks by seeing if the asset was able to make higher or lower slow stochastics readings. While momentum oscillators are best suited for trading ranges, they can also be used when securities that trend, provide the trend takes on a zigzag format. Pullbacks are part of uptrends that zig higher. Bounces are part of downtrends that zig lower. In this regard, the stochastics oscillator can be used to identify opportunities in harmony with the bigger trend. So in conclusion, the indicator can also be used to identify turns near support or resistance. Should a security trade near support with an oversold stochastics oscillator, look for a break above 20 to signal an uptrend and a successful support test. Conversely, do the same with the 80. Now, the settings on the stochastic oscillator depend on personal preference, trading style, and time frame. A shorter look-back period will produce a choppy oscillator with many overbought and oversold. So we were looking at a 14 period, which is the standard, but you can go to a 12 or a 10. But then you have to check it more, because then it's no longer just stochastic. It's Brian stochastics or Robert stochastics, and you can't use the standard variations. But if you want to bring stochastics into your world of trading, you can modify it slightly and test it over a period of time. A longer look-back period will provide a smoother oscillator with fewer overbought and oversold readings. So you might want to move it to 16 or 18 to give you less indicators, less overbought and oversold bounces. Like all technical indicators, it's important to use stochastics in conjunction with other technical tools. Volume, support and resistance, and breakouts can be used to confirm or refute signals produced by stochastics. So thank you very much for joining us tonight. I hope I gave you a little food for thought. Please use the handout and enjoy it. And if you want more information, go to www.aetos.com and open a demo account and take advantage of all of their educational materials. Have a good night now, and we'll talk to you again later. Thanks.